stocks are at an all-time high. The bull run's just getting started. Wait, is it fool's gold and a crash is coming? What should you do about it? I'll answer those questions and more for you right now. Welcome back, everyone. In this video, we will talk about 5 counterpoints to the reasons the next bull run is here that show a crash is coming, and a warning before you sell or short the market, and I'll tell you what I'm doing personally. And if you like making money and are looking to learn and invest alongside a guy with a crooked head and no real girlfriend, is there such thing as a fake girlfriend? Anyways, what's not fake is the great community of new cool kids where everyone is invited to be one that I'm a part of. So if you want to be a part, go ahead and subscribe, hit that little notifications bell, and while you're down there, go ahead and hit the like button as well. And don't forget to follow me on Instagram too if you want to see me screw that up royally. And remember, this is for entertainment purposes only. If you haven't seen the first video in this series, I will link it at the end of this video, so make sure you stick around until then so you don't have to search for it. No, you don't have to watch them in order, but you should watch both so you can see all the sides of the argument and then make your decision accordingly. So let me lay out the 5 counterpoints to the reasons the next bull run is here that show a crash is coming. But before we get rolling, just like the other video, make sure you smash the like button right now, as I know this video will get a ton of hate from the other side because I cannot make everybody happy. So I'm trying to make everybody happy on both sides of the fence, but it's not gonna happen. So just go ahead and smash that like button so that way it just balances each other out. I like yours if you like mine. Wait. The first reason the next bull run is here was the Fed. We've all heard it by now. You cannot fight the Fed. The same goes apparently for the stock market. They're not fighting it either. The Fed money printer has been working overtime, putting trillions into the system. This has pushed money out of bonds and out of safe investments and into stocks. Not going to argue that at all, but I will offer this counterpoint. Actually, there are really 2 counterpoints to this one. The first, the Fed cannot continue to do it forever, and if inflation starts to creep up, they will have no choice but to stop and raise interest rates to stave off inflation. A Fed-induced bubble does not create new tiers of valuation long term, and more importantly, the Fed does not make a bad company a good long-term company. So while many companies are enjoying a monster run on their stock price right now, the companies that were bad before, or even if they weren't bad before but now they're devastated because of this crisis, are not magically going to be more valuable coming out of the crisis when support is rolled away and the real truth that the business is bad, damaged, or worse comes into plain view. It's not like this is a small group of companies and most companies are in spectacular financial shape. If you think most companies are in great financial shape, my guess is you're only looking at stock quotes and YouTube videos, but not diving into the balance sheets and the other financials. Because if you did, then you would have a clue as to what the underlying business is doing. And when all those underlying facts come out, it will trigger a crash. And the second trigger point, there is only one kryptonite to the Fed. The Fed can try, but they will not be able to prevent a slide back down just like they couldn't back in March if the illness comes roaring back and the rest of the world shuts down again. Now, I agree they can keep it out of the abyss, but it won't stay anywhere near all-time highs like it is right now. But one thing remains true through both videos, where you think it's going to crash or you think it's going up. The Fed liked and subscribed, so don't fight the Fed and just do it. The second reason, 2020 is a repeat of 1968 in the US and the market looks identical as well. 1968 was eerily similar to 2020 for many reasons. Divisive elections, protests, pandemics, huge stock drops followed by huge rallies. The similarities were so similar, I don't think you can pick 2 years so far apart that look so similar in terms of social and political unrest, along with major pandemics and spectacular market moves so similar. Counterpoint to all that. Although in terms of social and political unrest and the illness stuff, it is crazy similar, the fact is the underlying economy was not in terrible shape in 1968 like it is now. Now, before you run to the comments, I know you hadn't done your research on what the actual economy was doing in 1968, so let's look at the data. Fact, the unemployment is at 13% right now. Fact: the unemployment in 1968 for the year was 3.4%. Fact: GDP growth will be negative for 2020. Fact: GDP growth in 1968 was at 4.9%. So the two indicators that are widely believed to be two of the best indicators of the health of an economy are slanted hugely in favor of 1968 compared to 2020. But let's look even deeper. We're not giving 2020 a fair look. Let's look deeper. When was the last time the US unemployment rate was at 3.4% or better like it was in 1968? The answer is never. In the past 52 years, unemployment has never been at 3.4% or lower for the year. Never. But what about GDP growth? In 1968, it was at 4.9%. When was the last time it was that high, you may ask? You have to go all the way back to 1984. 36 years. So probably the biggest reason for the turnaround in 1968 was the economic indicators were historically good compared to pretty much any other time since then. So while the social and political unrest are very similar, the data shows the economic similarities are not even close. So the 1968 market return from the unrest makes complete sense given the strength of the economy. The 2020 return of stocks looks eerily similar to the tech bubble, not the 1968 V-shaped stock recovery. The third reason? Computer traders. Algorithms and computers run the trading and the models that humans look at today. They are always looking for opportunities based on numbers, and they don't read the headlines, so they don't trade on it. Basically, the computers aren't trading on emotion, so they don't care about all this other stuff going on. They're just trading based on data only. The counterpoint to all that is, although the computers are growing in influence in the trading market, humans in the end can override them at any time. Warren Buffett doesn't even have a computer in his office, although the rumor is he had one installed just so he could subscribe and watch my videos for stock tips. But that's just a rumor. So, don't go spreading that. Don't put that on Instagram. Can't do that. It's just a rumor. And many of the biggest players in the game use the computers as one of their many tools in the tool belt. So the human element is not as removed as some make it out to be. And if the economy falters, or we have to go back under some form of lockdown, you can bet the humans will override the computers and be selling, therefore causing a crash. And the fourth reason, unemployment dropped huge, showing that a V-shaped recovery might be in. Now you guys know I don't do politics like I said in the last video, so let's not get started now. But whether the numbers are adjusted or the reported numbers, unemployment dropped huge from April to May. And with the majority of the US and the world reopening further in June, that number should go down again big in June. So the stock market should take off. Counterpoint. Even at 13%, this is still historically bad. The highest rate during the Great Recession was just over 10%. So the job situation was better then than it is now. And we are still worse than any time in history except for the Great Depression. And 1 or 2 good months of unemployment data does not mean that the pace will continue. If you believe every company is going to immediately bring back workers out of the goodness of their hearts, you would be wrong. If you think employers who have figured out that they can do more with less employees are going to come back to those same employment levels before the illness and just ignore those profits that they sorely need and those efficiencies that they've gained, you would be wrong. If you think employers, knowing that the labor market is significantly weaker, will not use that to their advantage, you would be wrong. Now slow down, slow down. I don't think all the jobs will disappear and we will stay at 13% or 10% or whatever forever. I also do not think we will just go back to unemployment rate being back under 4% again or better. Unfortunately for stocks, and when you're looking at the market, that is exactly what the market has priced in right now. Just unemployment snapping right back under 4%. So anything short of that mark in the next 4 to 6 months will cause a drop in the market. And the further off they are from that mark, the bigger the drop. And the fifth reason, old guys are finally behind on the times and outdated, and there's more new investors than ever. Warren Buffett is sitting on $130 billion plus. He's lost $50 billion plus in the first quarter, and obviously hasn't made any significant plays in the second quarter, and he's missed out on all of these huge gains that have happened since the correction started. Most likely, Even people like you and me are doing better than Warren Buffett this year, and in some cases a lot better. With trading platforms like Webull and Robinhood helping give the retail investors a way to easily invest, link in the description if you'd like 2 free stocks from Webull, and pros like ARK Invest changing the fund and investment game altogether, a new era has arrived. Counterpoint to that. I heard this exact talk in the tech bubble and the financial crisis. Warren is too old, he is out of it, a new era has arrived. And usually when articles and videos start appearing talking about exactly that and preaching this, a bubble is forming and a crash is imminent. It could be a month from now, it could be a year from now. But a guy who has been a net buyer of stocks every year through every downturn, having seen more in stock investing than most of us will in a lifetime, is suddenly scared, confused, and doesn't know how to invest is just ludicrous. But that's the narrative that's being pushed out there right now. He may have missed out with some major gains with the airlines, but let's see in 6 months all the people holding airlines who are burned when the actual data comes out about their revenue. Oh, and there are a ton of billionaires out there sitting this one out. Check out some of my other videos where I lay out exactly what they are saying as to why they are just sitting this one out. Are suddenly all the billionaires stupid and know nothing, and the chat room warriors are suddenly stock market gurus? Really? Billionaires hold the smallest share of the market they have held in years. And retail investors hold the largest share of the market they have held in years. But I really don't like the way that equation works out at all in the end, in my opinion. So that to me is a sign right there that there could be trouble coming. A warning before you sell or short the market, and what I'm doing personally. Hopefully you feel like I've effectively laid out a case for why there will be a crash that's coming. If you haven't seen the first video about how there won't be a crash, it will pop up at the end right here in just a second. So don't miss out on that if you hadn't seen it yet. So given everything I just laid out, what should you do and what is the warning? The first thing you should do is like the video and subscribe if you haven't already. Yes, I said the exact same thing in the last video. I'm sorry, but it's just a friendly reminder and YouTube makes me do it. Hey, that's better than saying social media made me do it. But should you sell or short the market if you think the market will crash? The answer is answered by your answer. That's too many answers. By your answer to this question. If you sell and the market continues to rise, will you have regret FOMO? That is where you regret selling and now feel extra FOMO because you already missed out on the gain since you sold. And what happens if it continues to go up? That is the problem with market timing and not having a plan or a strategy. If your plan was,
I'm going to sell today, and tomorrow the market will drop back down so I can buy, and then it will go up the next day again and I'll make a killing.
That's not how this works at all. What is your buyback point? How high does the stock have to go before you admit you were wrong and buy again? What are those numbers based on? What analysis did you do? FOMO is killer both up and down, whether you were selling or buying. The link to the free FOMO group is in the description, and I've made a couple of FOMO videos. I'll link those at the end along with a video about why the stock market won't crash so you don't even have to search for it. If there is any emotion in your decision or reasoning at all, you may want to evaluate your decision further before selling or shorting the market. So what am I doing personally? I'm personally holding my positions firm in case they continue to run, and I'm also pulling cash to take advantage of opportunities as they come up. The market will always provide opportunities even if it doesn't crash, and if it does, I'll be ready. Either way, I have a plan for my money now. If the market continues to run, or if it crashes, I'm ready to pounce as well. Will I be right on everything and every pick I make? Of course not. But I've seen this show before, and it's not going to end well for some out there right now. So make sure you are subscribed and you follow me on Instagram and all that good stuff, so that way you can get real information like I gave you today. And you will know things like when my course drops, where I will teach you exactly how I build wealth step by step. So the first thing you need to do is click these videos right here to get the first part about why the market won't crash and for help with FOMO. Thanks.